What's up, you guys? Crypto Clay here, and in my last video we discussed the different types of exchanges. Now, we discussed ones that you should shy away from and ones that are highly respected in the cryptocurrency community. Today, we're going to be talking about how to generate your first trade, looking at different types of orders, and we're also going to talk about the different types of wallets to use after you've placed those trades. So let's go ahead and jump right into it. Now, before you can go on an exchange like this one, which is Coinbase Pro, you have to go and set up an account. And to do that, you have to do a couple of things. Now, for starting out your account, you're going to have to do some identity verification, which is going to be a very simple process of just uploading either your driver's license, your state ID, or a passport picture. Along with that, you're going to have to verify your address. Now, if you're saying to yourself, I don't want to do that, I don't want any entity or exchange to know my identity, there are definitely ways around that, and you can look up exactly how to do that. However, in today's tutorial, I'm going to be showing you guys how to do it with identity verification using exchanges like Coinbase, which require that. After you've set up your account, and you've gotten to the point where you can place a trade, you have to go and set up either a bank account source or a debit card source. On exchanges like Coinbase, they allow you to do either. You can also do wire transfers, which take a little while longer and require a fee of, I believe, $10, but for me personally, I like to use both the ACH transfers and the debit card transfers just because they're really easy. The debit card transfers allow you to access those funds immediately, whereas the ACH transfers usually take about 3 days to access those funds. Okay, now you've gotten to the point where you've set up your account, you've set up what you're going to be funding your account with, so whether that's your debit card or your bank account, and you're ready to place your first trade. Now, you go on to an exchange like Coinbase Pro, and you see that there are these two options here, buy or sell. Now, you're obviously going to want to buy since this is going to be your first cryptocurrency trade. Then below that, you're going to have three options here: market, limit, and stop. The first option, market, is going to be a set price that you cannot control. That's basically the price that the market is currently setting by all of the buyers and sellers. So whatever the current price is that you see right here, which is 190.96, is going to be the market price. So that actually could go up depending on the amount of orders in the book currently. It could also go down. It just depends. Generally, it's always going to go up whenever you place a market order due to the fact that you're purchasing off of the book. The next type of trade is going to be limit. With a limit order, you're basically giving the book the price that you want to purchase that asset at. So let's say you want to purchase Ethereum, but you don't want it at the current market price. You could set the price for $180 if you want to. So what you would do is right here, you would type in how much Ethereum you want and the limit price of $180 US. With this example, we're using USDC, which is just US dollar coin. It's pegged to the US dollar, so it's going to be roughly the same amount. But that is a limit order, basically going and telling the market exactly what you want to pay. A stop order is a little bit different than a limit order. It's taking a limit order and just adding an extra step. With stop orders, you're basically going to be putting the price at which you would like to start your order in the stop price, the amount that you want to actually trade. So if you wanted to buy Ethereum, you would put the amount of Ethereum that you want there. And then the limit price is just going to be near or the same as your stop price. That is going to be the price at which the order actually executes. Once a price has been reached on that stop price for buy orders, it's basically going to be above what the market is currently trading at. So for a stop buy, it's going to be above this 190.37, but once it reaches a certain limit. So let's say you have a target of a limit that you think that the price could go to. This stop price is going to be at that level, and then it tells the market, okay, I want to buy at this limit price since my target has been reached. That is what a stop buy is. However, for a sell, it's going to be the exact opposite. A stop sell is going to be once you've placed an order and you have that order on the exchange and you want to make sure that you don't lose any of your profits, or you don't want to lose a significant amount of your holdings, then you would place a stop sell order so that it limits your profits. For a stop sell, let's say the price is at $190.37. It's going to be somewhere below that. Let's say we place our stop sell at $180 because we don't want the price to go below that. At that $180 mark, if we post $180 here for a sell, and our 2 Ethereum that we have, and then the limit price is going to be 179. So let's say the price plummets and goes down to $180. Once it reaches that mark, this stop order is going to make sure that you sell off your holdings so that you don't lose a significant amount of money. That is what a stop order is. It's a little bit more tricky than your limit or market orders, but it's still a very simple trade that can be executed to make sure that you minimize your losses and accelerate your gains. The next thing that I wanted to talk about was crypto exchange fees. Now, there are definitely workarounds for fees on different exchanges, and you'll have to look up some of those ways to avoid fees on some of the more popular exchanges. Like with Binance, if you use BNB, you'll actually get a discount on every single trade that you use their token on. For Coinbase, though, this is one of my favorites because it allows you to transact with no fee at all, moving from a bank account to Coinbase. And that is, if you use an ACH transfer to buy cryptocurrency on Coinbase and you buy USDC, so US dollar coin, there is absolutely no fee involved. Now, if you use a debit card on Coinbase to transact into USDC, there will be a small fee associated with that. But an ACH transfer onto Coinbase buying USDC will give you 0 Coinbase fees at all. And what you can do with that is once you've made that purchase, you can trade into whatever asset you want. What's cool about this, though, is that I could make an order on Coinbase for USDC, purchase that, and then transfer it over to Coinbase by going over here and clicking deposit, going to USDC, and trading from Coinbase to my portfolio on Coinbase Pro. And it's that simple. So you place a trade on Coinbase from your bank account into USDC using an ACH transfer, and then you transfer that USDC to Coinbase Pro, where fees are dramatically cheaper than Coinbase.com, and you can trade into whatever asset you want from there. If you go over here to select market and you click on USDC, These are all the pairs that you can currently trade into from USDC. So if you want to buy Bitcoin, Ethereum, BAT, any of these will work. Now, obviously, Bitcoin is going to have the most pairs on any exchange. So if you wanted to buy some Bitcoin and then maybe trade this to another exchange that has more pairs with Bitcoin, that would be the way to go. There's so much you can do with that, and this is only one example of how to get out of some of the fees that are associated with cryptocurrency exchanges. I just wanted to show you guys that so that you don't get bombarded with all of the fees on some of these exchanges. Before you can begin to trade, you must determine what strategy is going to fit best for you specifically, because everybody is different. Everybody's strategy is going to be different. No one is going to trade exactly the same. However, if you do want to trade like somebody else, there are definitely avenues out there for that. You can go on TradingView and look at some of the professionals that trade and definitely mimic their trades. A lot of people even have paid subscriptions for things like that. And you can definitely do some minimal research and go about that if you choose. Or you can use your own method, your own strategies to trade the way that you want. You need to decide whether you want to be a day, swing, or bag trader. So the difference between those are day trading can be incredibly difficult in this market. This market moves much faster than others, but the idea of day trading is to make small gains each day that will eventually grow your portfolio over a long period of time. Now, like I said, that can be incredibly difficult in the way that this market moves. It's very difficult to analyze and decide how the market is going to move on a day-to-day basis. You know, one whale could decide that he wants to sell off his holdings one day, just like it happened the other day, and crash the market in, 15 minutes. You never know what can happen day to day. So for me, day trading is not really the way to go anymore. I used to dabble in day trading in cryptocurrencies, and I enjoyed some profits doing that, but I decided that the stress of it just wasn't worth the risk. So for me, day trading is not the avenue for me. Next, we have swing trading, which is capitalizing on larger moves in the market and can take anywhere from days, weeks, to even months. Some people have been trading on years, swing trading on years. Now, for that, I definitely wouldn't call them a swing trader. However, I've definitely heard some people call themselves swing traders after holding an asset for several years. I don't consider that swing trading, but any of those other time frames that I mentioned, days, weeks, months, if you're holding for a specific trend in the market, that is going to be your swing trading. And that, I think, is probably one of the most profitable ways of trading right now in the cryptocurrency market. However, you'll have other experts tell you differently, I'm sure. There are a lot of people that will tell you that day trading is the way to go, and that's perfectly fine. They can tell you that. But for me personally, I think swing trading is probably one of the most profitable means of trading in the current cryptocurrency market. The last avenue for trading that I talked about was bag holding. And bag holding is basically going to be taking an asset, putting it in a wallet, and holding on to it until you decide at a later date that it's time to sell. And there can be multiple reasons for why you want to sell that asset. Again, that's going to be on you and why you decide to do that. I can't tell you exactly why you should trade an asset, but bag holding is currently my way of trading. I take assets and look at them on a fundamental level, and I decide whether or not I like that project. And if I do like that project, I purchase as much as I possibly can and hold on to it. Now, I have several of those types of assets in my current portfolio, and I'm holding on to them and I'm not trading them at all. There are still a couple of things that I trade on the side, but not very much value. A lot of my portfolio is going to be in these bag holding scenarios. So those are your 3 types of strategies that you can use moving forward with trading cryptocurrencies. There are other methods that you can use along with that. You can use a variety. You can hold some bags of some things, you can day trade certain things, and you can swing trade on other things. You can mix and match any way that you want. There really is no specific plan that is going to be better than others. It's all going to be based on your specific needs. Don't let anybody persuade you that one is better than the other, because it's all based on your perspective when it comes to these things. If you think that 1% gains are good for you, then 1% gains are good for you. Don't let somebody tell you that, oh, you could have made 10 or 20%. Once you start getting greedy, that's whenever it really starts becoming stressful, and that's whenever it starts becoming a little bit more of a grind than it should be. Now, if you're trying to go out there and hustle as much as you possibly can, good on you. That's not for everybody though, and I definitely don't encourage that, because the stress can become way too high. Not to mention, you can start getting too greedy, and that's whenever your profits start dwindling. And if you do go down that route, you'll know exactly what I'm talking about whenever that does occur. Alright guys, the next thing that I wanted to discuss with you guys are wallets. Wallets are very important for trading cryptocurrency assets, because like I told you in my last video, it's very important to not leave any of your funds on any of the exchanges. Exchanges can be hacked, your accounts can be hacked, lots of things that can go wrong happen on exchanges because they're a central point of failure. So please keep that in mind when you're trading cryptocurrencies and digital assets. It makes it very, very easy to lose all of your funds. And I can tell you from firsthand experience how bad it feels whenever you find out that the exchange that you've been trading on gets hacked and you lose all of those funds that you've poured your heart and soul into. There are 3 different types of wallets, and some people will tell you that 2 that I'm going to discuss are the same. I tend to disagree. We have hot wallets, cold wallets, and then hardware wallets. Some people will tell you that cold and hardware wallets are the same. I disagree, because anytime you plug a wallet into an online computer, it no longer is a cold wallet. And I only say that because programming is a very tricky art, and anybody with any brain and any programming skill has the ability to attack you on any online presence. So anytime you plug any hardware wallets into an online computer, that asset, that wallet, has the potential to be attacked. It's going to be a lot more difficult considering the fact that hardware wallets are built with encryption installed immediately at use. That extra added encryption makes it a lot harder to break into, but it is still possible. Now, I'm not trying to alarm anybody, I'm not trying to scare anybody. Hardware wallets are definitely the way to go as far as I'm concerned. However, you do have other avenues. A lot of hot wallets are wallets that you can use online for multi-asset wallets or things like that. I don't encourage anybody to use those unless you absolutely have to. A lot of wallets that you can find are on the assets websites themselves. So if you go to bitcoin.org and you want to download a wallet and run a node specifically for Bitcoin, you can do that. Or you can find other alternative methods for running a wallet. Again, anything online is going to be considered a hot wallet. Anything offline is going to be considered a cold storage wallet. So let's say you wanted to create a paper wallet. That would be considered a cold storage wallet. And there are plenty of tutorials online for you to look and see how you can transfer your funds to a paper wallet and safely store that paper wallet in a safe or somewhere secure that you know of. But you're always going to want to make sure that wallet is in a safe location that only you can access or somebody that you trust. I've heard stories of people that thought they could trust a friend and that friend stole their paper wallet, so please keep those in a very, very safe location. For me, my favorite hardware wallet is one that I've been using for years now, and that is the Ledger Nano S. It's very easy to use, it's safe, and it allows me to do all of my trading at ease, and I feel very comfortable knowing at the end of the day that my funds are secure on that hardware wallet. So those are the three types of wallets. The ones that I would encourage you to use the most are obviously cold storage wallets or hardware wallets. I don't encourage anybody to use those hot wallets, like I said, unless you absolutely have to. It's still going to be more secure than leaving your money on an exchange. Exchanges are just not the place that you want to store your funds in any means at all. A lot of exchanges are trying to incentivize people by allowing them to stake specific assets on the exchanges themselves. Like Coinbase allows you to stake Tezos. I believe that Binance is now allowing people to do the same. Other things like Atom and Cosmos are being staked on certain exchanges. Try and stay away from that. If you can stake using a wallet of your own, that's definitely going to be the way to go. Try to stay away from leaving your funds on exchanges at all. The last thing that I want to mention is that anytime you are sending your money off of an exchange, make sure that you go line by line and associate that wallet address that you're trying to send to is correct, 100% accurate. I've heard so many stories of people trying to send funds to their own wallet offline and they got some type of the address wrong, and by doing that it sends your funds to some place that you have no idea. It doesn't go to you and are no longer your funds. It's one of the main drawbacks to the cryptocurrency market, not being able to access your funds if you accidentally send it to the wrong address. So please, 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 whenever you're trying to send money off of an exchange to your wallet, verify that the address is 100% accurate. Otherwise, you will never receive those funds. That's going to be it for today's video. In the next video, we're going to be talking about margin trading, and we're also going to be talking about trading on arbitrage. Thanks again for watching today. If you enjoyed today's video, please leave me a comment in the comment section and let me know what exactly you enjoyed about today's video. And if you did, please like on the like button and subscribe if you haven't already. Thanks guys, Crypto Clay out.